Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Brooke Thackeray, research analyst at Global X, will be joining us for the hour. And we want to hear from you this morning on our first call segment. You can call us with your questions, and we'll have Brooke Thackeray answer as many of them as he can. At the end of the show, that is. The number to call will be 1-855-326-6266. We're going to open the phone lines in about 30 minutes from now. And also our email is firstcall@bellmedia.ca. Now, here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Brookfield are up in the pre-market today. The Toronto-based company reported record fourth quarter and full year results driven by strong fundraising and capital deployment. The alternative asset manager also raised a record $35 billion in the fourth quarter, bringing total fundraising for the year to more than $100 billion. Shares of Advanced Micro Devices are under pressure in the pre-market. The chipmaker's sales forecast underwhelmed investors, a sign that it's not making the AI inroads that some on Wall Street anticipated. AMD is contending with U.S. restrictions on what it can export to China, the world's biggest market for chips. U.S. President Donald Trump has moved to relax the curbs, but it has taken time to get the necessary licenses. ATS Corp saw a third quarter profit that beat expectations. Meanwhile, growth for the technology company was mostly driven by a 13% rise in revenue across almost all markets, except transportation, and a boost from foreign exchange translation. Looking ahead, the Cambridge-based company expects its order backlog to help mitigate the impact of variability in bookings on revenues in the short term. And now to our top line story. Stocks are rebounding today after a sharp sell-off yesterday sparked by a new AI tool from Anthropic PBC. So for more on this, we're going to bring in our guest host for the hour, Brooke Thackeray, research analyst at Global X. It's good to have you in studio. Thanks for joining us.
Thank you.
What we saw yesterday was pretty incredible. I'm not sure what your thoughts are on it. Was it a bit of an overreaction in terms of the sell-off?
Yeah, there's been a lot of questioning about the whole narrative around AI. So it's sensitive to any changes, any news formations, or anything that comes out. We're seeing the NVIDIA as well going back and forth with OpenAI. So when you have an announcement by a company, it's everything else can really suffer from that. So it's just, I think investors are really skittish at this point. Is it an overreaction? Do we expect this to continue to go down? I think we're going to see. And I don't think continue to head down the same level, obviously, but I think we're going to go back and forth here and slowly work our way more into reality here.
It's kind of like, 2025 seemed like a year for a conversation about AI and what's going to happen with AI in the future. And it seems as though 2026 is like, okay, we've seen all that spending for AI. Now people are kind of looking for results. Is this results, do you think, what Anthropic was releasing yesterday?
I think that there's more to it than just the results at this point, because there's just all that skepticism that's around. Is this going to pay for it? Is there circular deals going on back and forth? And we, like I mentioned, we saw NVIDIA talk about, well, we're not going to give money to OpenAI. And then OpenAI come back and say, well, maybe we're not going to use NVIDIA chips. And that whole circular flow diagram that we've seen with Anthropic and everybody else going back and forth, that seems to be falling apart a little bit at this point.
It shows almost how vulnerable some companies are to any kind of this is quite steep competition. Obviously, this tool coming out, a lot of companies feeling that pressure now. It shows just how vulnerable companies are to competition.
Yeah, so if we go back and we take a look at with AI, everybody's saying AI is the future, and it is the future. But there's room for everybody because we're growing so fast, and it was growing so fast, and still is growing fast. And everybody can do well in the space. But now all of a sudden we're becoming more competitive here. And we've seen that with Google coming out with their TML chips versus NVIDIA as well. Oh, there's other chips. NVIDIA doesn't have the only chips. And so we're seeing with Anthropic as well, all of a sudden producing different platforms where now it's more competitive. And I think we're in that stage where we're seeing more fiscal responsibility, more competition come in. So we're going to see these reactions. I don't think it's going to all of a sudden keep continuing heading down here. But I think we've seen the best of the rapid rise around the AI stocks.
It was interesting, though, the reaction, right? And we kind of saw the ripple effect of that throughout the markets. Like, I'm not sure if you noticed other sectors like the financial services and asset managers sectors. Like, there was a ripple effect from the tech sell-off that we saw yesterday.
Yeah, there's no question that's what happens because tech really tends to drive the market a little bit. It's a real beta sector, so when investors pull back from that sector, we see it spill over into other areas as well. And tech got hit hard. You look at Shopify, it got hit hard yesterday. It was down almost 10%. And it releases its earnings next week. It wasn't like it was coming out with big earnings or anything. So we saw it just ripple right throughout. And that's going to happen. With technology, actually, as far as the S&P 500, makes up about 34% of the S&P 500. So it's a huge chunk from that standpoint, from a capitalization standpoint. However, there were sectors that did do well, for instance, in some of the cyclical sectors and the mining sectors, et cetera. So it didn't go out throughout the whole market. It did spill over, but it didn't hit absolutely everything.
So with that in mind, I mean, how should investors be looking at this? Like, should they be going to those sectors that weren't really touched by what happened yesterday? Or as you say, it's not going to be a long-term thing when we're seeing this sell-off of other techs?
Well, I think we're in a real generational change here a little bit. So I think, although I don't think we're going to see this big, huge collapse continue down, I do think we're going to see it whittle down. Technology has been underperforming since October.
Right.
And we're seeing this up and down here. And I think we're seeing a rotation take place. And that's why it's susceptible to these big, huge corrections that take place. We're seeing a rotation from the growth sectors of the market, particularly technology, into the cyclical sectors of the market. Investors still want to be invested. It's not like they're trying to leave the market. They're saying we want to be invested in other sectors. And I think that's going to continue. I expect the technology sector to continue to underperform. At this point, I think investors are still going to move into the cyclicals, and the big question is they're also going to move into the defensives as well. We saw the consumer staples sector up 1.6% yesterday, which is very interesting, a huge discrepancy with the technology sector. So it's saying that we're seeing this rotation take place, and it's just the market moving and investors moving. I don't think technology, as much as it's going to change the world, I think there's other places to be, and investors are now examining that, whether it's precious metals, whether it's some of the cyclical sectors like industrials.
Trying to diversify.
Yeah, we're seeing that broadening out. And more of a rotation, but we're seeing broadening out as well.
Okay, we're going to take a quick break right now, but of course, Brooke's staying with us for the hour. Up next, we'll take a look at the markets before the bell. Stay with us. Welcome back. Here's how things are shaping up on the markets. We'll begin with the U.S. futures this morning. It was a tough day yesterday after that Anthropic released that new AI tool we were just talking about, causing tech stocks to tank. That brought the markets down. It looks as though they're rebounding slightly in the pre-markets today. We'll keep an eye on that for you. In terms of how major Asian markets finished the day today, it was mixed trading. The Hang Seng, the CSI 300 rather, both up, fueled by rebound in AI-related stocks. And moving over to Europe, the FTSE is up at the moment more than a percentage point. The CAC 40 also up almost a percentage point, and the German DAX is currently down by 0.3%. Here at home, if we take a look at where the TSX finished the day yesterday, it was up by 0.6%. And if we take a closer look into the biggest winners and losers yesterday on the TSX composite, energy fuels up more than 16% to end the day. Taseko Mines also up almost 14%. Altus Group, though, down 11%. And then, of course, we were talking about this yesterday. Thomson Reuters finished the day down 15.8%, at one point down almost 20% yesterday because of that new AI tool from Anthropic. If we look at the price of the metals for today, we can see gold is rebounding above the 5,000 mark after that historic collapse from record highs that we were talking about. We're going to be talking more about gold and silver in moments. Silver also up more than 7% at the moment. Copper, though, slipping after its biggest one-day advance in more than 3 years. It's down about more than a percentage point at the moment. And if we look at crude oil, the price of oil swinging between gains and losses this week, currently up right now as investors are watching geopolitical tensions in the Middle East causing those swings. So as I just mentioned, gold has claimed above 5,000 an ounce yet again. So for more on what's moving the metal today, we're going to turn to Brooke Thackeray, research analyst at Global X, who's joining us in studio this morning as our guest. It's been a wild ride for gold throughout the start of 2026. I mean, what are your thoughts on what we're seeing with gold right now?
Well, it was being unrealistic. We saw both gold and silver have this parabolic shape, and up it goes. And you can never tell when that top is going to happen. And something is the catalyst that comes along, and all of a sudden, we see it correct, and you can't really tell how far it's going to correct. The fundamentals are still there for gold and silver. Mm-hmm. Yeah, currency debasement is still taking place as far as gold goes, helping to boost gold. Central banks still buying silver. Asian demand is still really hot for silver. So those fundamentals are still there. I think what we're going to see here is what we've seen in the past with the pattern for both of these. We've seen this pattern of rally, consolidation. And I think we're probably in some sort of consolidation phase here, where we're moving from, perhaps with gold to anywhere from 4,600 to 5,500 in that range a little bit. We're still, around just over 5,000 as far as gold goes. But I think we might see that go. And maybe it does go higher here too as well, but I don't see a lot of downside from this level.
What about the last day of January, we saw that really sharp correction that everyone's been talking about. Are we likely to see every once in a while throughout 2026 sharper corrections like that? I
think that was a little bit unusual. I do expect more volatility. I mean, that was getting kind of crazy. Every week is a green bar on the graph.
Yeah.
Up it goes, up it goes, up it goes.
And every day.
And every day.
Yeah.
It was just like a lack of volatility. I do expect more volatility on a go-forward basis. I think this is like a tremor, that we're seeing here. But I don't expect big days what we saw like on Friday. I think that was a little bit unique. We saw that announcement being made, but the east, the markets were closed. Like everything just sort of, the confluence of events that took place really affected what took place as far as the drop in gold and silver. I don't think we're going to see the same type of drops. I do think we'll see drops. And as I said, right now in a consolidation phase.
Obviously, part of the reason we saw, as you mentioned a couple weeks ago, that real spike in gold was when Donald Trump announced his pick for the Fed chair, Kevin Warsh. I mean, what are your thoughts on that pick and how that's fueling what we're seeing with precious metals? Yeah,
so one of the beliefs behind precious metals is that, the Federal Reserve is going to keep cutting interest rates and perhaps go back into some sort of QE. They announced what I call a QE light before recently as well, which helped gold because it's currency debasement. And that was the belief. Then Trump came along and nominated Kevin Warsh to be the next Federal Reserve chairperson. And that's really interesting because the market took that as being extremely negative for gold and silver. That was the catalyst. Yes. And so we saw a collapse on that. And the reason that took place was back quite a few years ago, Kevin Warsh came out and spoke very strongly against QE, quantitative easing, and said, I'm not for this. And he seemed very hawkish. He had this hawkish tone. So the precious metals investor said, well, this is bad for gold and silver. And we saw that really fall apart just for a day or two. I don't think Kevin Warsh is as hawkish as everybody's making him out to be. Now, you just have to think about it. Trump has interviewed everybody here. And I don't think, Trump would have asked, are you going to lower interest rates? I don't think he's going to say, no, I'm not lowering interest rate. Okay, you're higher. That's not happening.
That's what I didn't understand either, right? Because everyone's saying he's going to be more dovish than hawkish. Yet we know Donald Trump wants rate cuts, and he wanted to pick somebody who was going to do that. So, you were not there, obviously, but obviously, as you say, Donald Trump vetted all these people. What's going on there? Why Kevin Warsh?
Why Kevin Warsh? I think they've got some sort of agreement together that, and he's well respected. He did work at the Federal Reserve from 2006 to 2011. And so he's got that background. He's well respected. He does have those hawkish comments. But I think he wants to bring something different. I do agree he doesn't agree with QE, quantitative easing. So I think he might tighten up the balance sheet. And that's what he's always wanted to do. So reduce the Federal Reserve balance sheet. But I don't think he's against lowering interest rates. And I think he's going to try to bring a new regime to the Federal Reserve. So I think it's going to be surprising to everybody how dovish he actually is. And he's going to be lowering those interest rates. Just to go from a narrative from many years ago, I think that's wrong. I think he has a different viewpoint on how things can be done, and I think that he's going to surprise the market at how dovish he will be. I don't think he's going to come out right away and say, "Oh, we need to cut the federal funds rate by 1% right off the bat," like some of the other contenders. I don't think that's the case at all, but I do think he'll basically cut interest rates over time.
And you say that's going to surprise the markets, at least at first.
At first, I think so. Yeah, absolutely.
What does that look like, do you think? I mean, to take it back to gold and silver, where we started this conversation, like what is that?
That would actually boost gold and silver.
Right.
So, I mean, he gets a position in May, and then I think the first vote is really June. So that would be his first vote. So 5 months away from here, basically. And, from that, but I don't see anything, maybe even the first meeting or two meetings, but I think he's going to have a steady progression forward. What we're seeing with central banks and governments and how they're operating, and governments are really trying to move the whole curve forward to be short-term debt from long-term debt. And I think he's going to help support that on a go-forward basis. But I do think over 2026, as we move further into the year, I think he'll be very supportive of Donald Trump's cutting interest rates as far as loose monetary policy goes.
Okay, interesting. We're going to take another quick break, but up next, we'll be back with Brooke Thackeray, research analyst at Global X, to see why the energy sector is on his radar. That's right after this break. Stay with us. Welcome back. It is time now for On the Radar, and we're back with Brooke Thackeray, research analyst at Global X. Okay, so Brooke, you've got a couple picks here. We're going to start with the energy sector. So BMO SPDR Energy Select Sector Index ETF.
Right.
What do you like about this one?
Well, first of all, so this is a fund that BMO has, and it's based upon the U.S. energy sector. So State Street in the States has a number of big sector funds, including XLE in the States, which is an energy sector. And this is the BMO version of it in Canada. So that's why it's got the Z in front of it. So you're able to get the U.S. energy sector in Canada, and you can get it in U.S. dollars and Canadian dollars, either or, depending on the ticker symbol. But the reason I like this is I think the energy sector, first of all, is coming up to a strong seasonal period. And if we've seen the energy sector do well, the U.S. energy sector has actually lagged the Canadian energy sector on relative performance over in 2025. So I think there's maybe some more opportunity in the U.S. energy sector. I think they're both good. I think we're going to see this continued rotation into the commodities and commodity stocks as well. And I think, yes, sure, there's a possibility of a U.S.-Iran war, as far as that goes, but even aside from that, we're still seeing this rotation into the energy sector. And in the States, if we look at the graph from the energy sector, it's actually doing a breakout right now as well. So we're seeing a positive breakout, positive trend at the time when energy stocks tend to do well. So I think it's a good place as far as a part of a portfolio goes.
Just quickly, why was the U.S. energy sector lagging behind Canada's?
Well,
maybe there's a bunch of reasons and we don't have time to go into it, but I thought that was interesting.
Yeah, I mean, Canada's more of a value play. It's a little bit more specific. The actual mix between gas and oil is a little bit different. So there's a number of reasons.
Got it.
But I think we're seeing a decent opportunity as far as U.S. energy goes here.
Okay, your next on the radar pick is Eastman Chemical. What is it you like about this company?
So Eastman Chemical, the reason I like it is it has a really strong seasonal period here. I've written some books in the past, and this I've always included Eastman Chemical in here. It tends to do really well from a strong seasonal period from late January into May. And last year it had a terrible year, which is great. So it missed its estimates twice in Q2 and Q3, which is a disaster. It was kicked out of the S&P 500. So these are, and so now that's all washed out. It's a high dividend paying stock that's come back. It's trading a PE ratio of around 10. So I think that given that we're in that strong seasonal period for the stock and the sector, chemicals, I think this is, and it's being so badly beaten up. And we're actually starting to see some pickup here. You can see this here on the graph. We're seeing it start to do extremely well here just recently. So I think we're past all the bad stuff. So I like it.
And it's an upward trajectory after a bad year in 2025.
Absolutely, yes.
Yeah. And as you say, we're seeing that on the graph. Okay, your last pick is Global X Copper Producers Index ETF. Copper, obviously, always a big topic of discussion. What do you like about this one?
Well, full disclosure, I work for Global X.
Yes.
I think that what we're seeing here is we've seen copper do extremely well in 2025. And I think we're going to see the continuation of that. And the copper miners are doing extremely well. We're short copper. We don't have enough copper. It's not even close. It's not like, we're just off a little bit on our go forward plans as far as data centers go, EV cars, et cetera. we're just so short, and it takes forever to build these mines. We've heard this story before. The reality is catching up now. That's why we've seen copper do extremely well here with the graph here. You can see here rising rapidly, really, in the last few months in 2025. And I think that can actually continue. The trend can continue here. So I think copper miners is also a good way to invest in that sector.
Kind of scary, like not for copper. I mean, it's great for copper, but the lack of supply and the demand, that increasing demand, we're going to keep needing copper for so many things, and we just don't have enough of it.
Yeah, and if you saw Donald Trump announce that the U.S. is going to be doing a $12 billion strategic reserve. I think it's called Project Vault, if I'm correct, and it's going to have the critical minerals. So China stores minerals in case it needs things.
Yes.
But the way the U.S. works is, companies are ordering copper, or silver, or whatever it is, for just in time for their inventory. But there's no central hub. In the U.S., they have what's called a special reserve for oil, the SPR, and that's in case oil prices go too high or something. And so this reserve is released into the markets once in a while to help buffer out problems if there's a big problem. They want to do the same thing with critical minerals because they don't want to operate just in time. If all of a sudden they can't get something and you can't build a F-35 or whatever it is, that just doesn't make sense. So they're starting off with a $12 billion critical mineral special reserve. And I think it'll actually grow. So I think copper is part of that, by the way. So the demand's only going to get more and more and more here.
You're right. It is Project Vault. Very interesting stuff. Okay, we're going to take a quick break right now. Still ahead, though, Novo Nordisk's Chief Executive Officer has joined Bloomberg's Francie Lacroix, and we will bring you that conversation after headlines. Plus, our phone lines will open soon for our first call segment. You can call us at 1-855-326-6266. Or you can send us an email at firstcall@bellmedia.ca. We'll be back in a moment. Suncor Energy beat fourth quarter revenue and profit estimates. The Calgary-based company posted a record-breaking year and achieved its 2024 Investor Day targets a full year early. The oil sands company reached record quarterly upstream production and refining throughput. Suncor also reached record refined product sales annually. The energy company has increased its quarterly dividends by 5%. Brookfield has named Connor Teskey their Chief Executive Officer, ending Bruce Flatt's 2-decade tenure as asset manager. Flatt will remain chair of the board and continue as Chief Executive of parent company Brookfield Corporation. Flatt says the move is the culmination of a succession process that began 4 years ago. The appointment was announced alongside Brookfield's record fourth quarter and full year 2025 results. And shares of Uber are falling in the pre-market today. The rideshare company logged a jump in fourth quarter revenue fueled by food delivery, but issued a weak profit outlook and missed expectations on earnings. Uber has invested hundreds of millions of dollars in autonomous technology partners and has agreed to purchase fleets of robo-taxis, which it plans to eventually launch on its popular ride-hailing platform. And we'll take a look at the U.S. futures mixed trading today before the bell. The Dow is up. Currently, the Nasdaq is down. The S&P 500 is up. Of course, all these markets rebounding after a sharp sell-off of tech stocks and some other sectors yesterday after Anthropic released its new AI tool. We'll continue to follow that for you today. Novo Nordisk Chief Executive Officer Mike Doustdar joined Bloomberg's Francie Lacroix to discuss the company's outlook as it faces headwinds on its main obesity and diabetes drugs. Doustdar told Bloomberg Television he is confident that, quote, the volume buildup will happen. Take a listen.
We have been speaking to the investors, trying to explain that in order to expand market, and we need to expand market in our business, we need to reduce the prices, so we increase affordability. Of course, it was well publicized that in the U.S. the prices from a very high level were coming down within the GLP-1. Our company is quite concentrated compared to many other pharma companies within the GLP-1 segment. So when you, of course, get a pricing headwind on your GLP-1 products, Wegovy Wegovy and Ozempic, you feel the pressure of that more. But also on the back of course, being a focused company and being the best in what we do, we feel very confident that the volume buildup will happen script by script, and we have seen the early signals of that with our Wegovy pill launch. So I'm very hopeful that while we're disappointing the investors today on a short-term price decrease, they will be quite happy to see that we will be able to obtain a lot of gain from the volumes that entails within diabetes and obesity.
So you're basically saying, look, trust us until this happens, right? Until the volume uptake makes up for the price decreases. When? Is it this year? Give us a timeline of when you think you'll see that turn.
I think what most people would recognize with diabetes and obesity, this is a condition that unfortunately affects billions of people. Close to 2 billion people have diabetes, obesity, and overweight. Everyone also knows that together with our competitor, we are only treating some 20 million of these billions of people. Everyone notices that GLP-1 market as a segment is growing, and we have been able to actually show that we can take part of that growth. This year we'll be growing once again, and we'll be producing more than ever before, treating more patients than ever before. But of course, when your base gets repriced in United States and US is some 55% of our business, you will basically see the headwind and the results of that within 2026. I am much, much more hopeful as we pass through this period that the volumes will compensate for the price decrease that you've seen.
I mean, given where we are now, can you rule out another round of layoffs?
We don't have any plans of mass layoffs, but I also tell our own employees as well as the external world that we are readjusting our business as we go forward. And as a result of that, in pockets of the company, we will be hiring more. I think right now, currently, we have some 400 open positions. But there are other parts of the business where we are reducing our capabilities. So that's business as usual. What you saw last year with 9,000 employee cuts is not in the plan for 2026. And as long as we grow and make more patients into our products, come into our products, then of course it's more of an upside than a downside when it comes to headcounts.
And this would be for the whole year. So you're basically ruling that off, even if the uptake in volumes could take longer than expected.
I am right now looking at the first early signs of volume uptake. That's our Wegovy pill that after 4 weeks has been given to 170,000 individuals. If you put that in the context, that's 2 times more than tirzepatide did in their first month of launch, or 15 times more than when we brought Wegovy injectable. When I see volume uptakes like that, I get encouraged about the longer-term future.
I mean, do you worry that the oral Wegovy could cannibalize the Wegovy injection?
The early signals are that some 88% of the patients that are coming into Wegovy pill are buying the lowest dose, the 1.5 milligram of the product. That's a very strong signal to us that these are new patients and not those who are coming from the injectable ones. There could be some small cannibalizations, people who need, to take a pill instead of an injection. But I would say a lot of people have been waiting to use GLP-1s, but injectable was not the path they wanted to take. Wegovy pill gives them the same efficacy as the injectable Wegovy at 16.6% weight loss. So we're seeing a very good uptake of these new people coming in.
Do you feel confident that Novo can compete in the long term, in the long run, without a monthly obesity shot?
Absolutely. First of all, we do have monthly products in our pipeline, and we will share and show that in due course. But more importantly, I feel that Novo Nordisk, by being a focused company, probably has the best pipeline right now in the industry. And we also have manufacturing skills second to none. 2 things that many of the new players coming into this market sometimes underestimate. And then we have the commercial capabilities, and we are very quickly learning how to mass product these GLP-1s via our partners. So I feel very confident for the building blocks that Novo Nordisk is building the future.
Mike, I know there's a lot of hope for CagriSema. How confident are you that you'll get the right trials? I think we're expecting something quite soon on that. And how easy would it be then, if you do get the right approvals and the trials go well, to scale it up?
So we have filed for approval, and we hope to get that approval later on this year. That would make the CagriSema launch early next year, and perhaps the first amylin molecule, combined molecule, that will hit the market. So once again, testament to Novo Nordisk innovation powerhouse that it is within this area. It's a fantastic drug that I'm looking very much forward to, with the highest efficacy than any other product today marketed. So that's, of course, incredibly exciting. And more to that, we will try to make that the best launch again, only surpassing what we've done now with the Wegovy pill.
That was Novo Nordisk CEO Mike Dustar speaking to Bloomberg's Francie Lacroix. Well, still ahead, our guest, Brooke Thackeray, research analyst at Global X, has his eye on uranium. We'll bring you a sector spotlight right after this. Plus, our phone lines are now open, and Brooke is taking your questions today. Call us at 1-855-326-6266, or you can email us at firstcall@bellmedia.ca. Welcome back. The supply-demand imbalance of uranium is leading to a surge in nuclear stocks, with share prices gaining 227% in 5 years. For a closer look at the uranium sector, we turn to Brooke Thackeray, research analyst at Global X, who's joining us in studio today. Brooke, you say the uranium sector is under-owned by most investors. Why do you think that is?
Well, the story's been there for a long time. We don't have enough uranium. We all know that. We have this deficit that's going to continue on for many, many years. And we're going to build a huge amount of nuclear facilities over time.
Yeah.
So we know all those facts, but investors still haven't made those commitments to actually own the sector as a part of their portfolio as much as they should have. And so investors are still focused on the technology sector, which we were talking about earlier on. But they're starting to wake up to the fact that we don't have enough uranium. And I think that will change over time. And I think we're going to see a multi-year run. Yes, as you said, it's done 227% over 5 years. But that's nothing. If we compare that to back, from 2001 to 2007, the sector went up month after month after month. And everybody would go, oh, it can't go up anymore. When we're in that type of a cycle, a super cycle, it can keep going. I think we're just at the early stages of this uranium bull market.
Why don't we have enough uranium? Is it kind of a situation like copper, as we were talking about before, or is it a little different?
So uranium, it's a little bit different because we haven't seen all the mining, we haven't seen money being put into mines, basically. And so we've seen to greenfield a uranium mining facility, it's 10, 15 years. And so we haven't seen that commitment over time. And so all of a sudden what we've seen this pickup as far as nuclear demand, as far as the green energy scenario. So now it's considered green. And so everybody's planning to increase the amount of nuclear facilities over time. So we're seeing a couple things here right now that are actually very positive for uranium. One of them is that we're starting to see the spot price of uranium go up. And you have to understand what's happening is the utilities, the nuclear companies, have been playing chicken with the price a little bit. They're buying on the spot market. They're saying, well, we'll buy on the spot market because we can just delay putting off the longer term contracts. They've done that for a while now. Spot takes up about 15% of their overall contracts, but they've been really pushing on the spot. Now they're actually moving out longer term, and we're seeing the uranium, the actual price of uranium, move up in the longer term part of the curve with the contracts that they're signing. And that's good for the uranium mining companies. So we're seeing that happen now. There's just a realization that before it was the buyers in control, and now we're starting to see the sellers gain some of that control. And I think that's going to be a long-term trend. We're seeing that inflection point take place. So I expect uranium to move up over time. I don't see a rationale in anybody's world where uranium moves substantially down in price. And so I think investors are going to start to realize this and start to be more and more invested in uranium.
Interesting. When it comes to like demand for uranium, you're talking about, nuclear energy, and obviously we're seeing that build out in Ontario, across Canada, as well as around the world. Is that where most of the demand for uranium is coming from, is nuclear energy? Because I didn't realize uranium's used in a lot of like the defense companies need it too.
Yeah, so that's a smaller part of the uranium demand. So, for instance, the Department of Defense in the U.S. actually has their own nuclear facilities. Some of the subs are run on nuclear, et cetera.
Okay.
So there is some of that, but by far the biggest portion of that is nuclear power. The governments are putting in place to help support the grid and the electrification of EV cars and data centers. And now companies are moving into, trying to produce their own power. And they're seeing more of that happen. So the U.S. basically said to the hyperscalers, well, hey, you're going to have to start paying for your own power. Like you're going to have to start having your own facilities. In the longer term, that's going to be nuclear. We all know that. It's just getting there.
Right.
Because it's going to take a while. Even if you're using SMR, small modular reactors, the big picture is that we just don't have enough power coming online, and nuclear is going to have to fill that. It's just going to take some time, and it's going to be volatile. Please don't think that this is like all of a sudden, hey, it's going to keep going up, like what we've seen with gold, for instance, over the last few months, except for just recently. But I think it's going to be volatile. But over time, I think we'll still see the sector move up substantially.
Okay, we're going to take another quick break right now, but still ahead, we'll take a look at some of the notable analyst calls and recommendations that are moving the markets today. We're going to be focusing in on PayPal. That conversation coming up right after the break. Welcome back. Let's take a look at some of the notable analyst calls and recommendations. PayPal is seeing a lot of action today after announcing a new CEO and as the firm reported profit and revenue that fell short of expectations. Citizens has downgraded PayPal to market perform from market outperform. Analyst Andrew Boone said the competitive nature of payments now appears more intense than we realized. And given the transition to agentic commerce that feels increasingly inevitable, we are unsure of PayPal's ability to compete and sustain margins. Meanwhile, TD Cowen analyst Brian Bergen cut the target on $48 from $65 and maintains a hold rating. And Morgan Stanley analyst James Fawcett also cut the target on PayPal to $34 from $50, maintaining an underweight rating. While Compass Point Research and Trading LLC analyst Dominic Gabriel raised the recommendation on PayPal holdings to neutral from sell, setting the price target at $51. So lots to watch for today when the market opens. As yesterday, PayPal shares closed down 20% for the worst day since 2022. So for more, we're going to bring back in our guest, Brooke Thackeray, research analyst at Global X, to talk about what we're seeing with PayPal. I mean, results were weaker than expected. The change in CEO was sooner than expected. What do you think is going on with this company?
So it's been lagging for a long time. And the big reason is it just hasn't kept up as far as the intelligence, the AI, the whole platform. It just hasn't kept up its innovation, basically. And there's other alternatives coming along. And the big one, I guess, is the agentic experience. And what I mean by that is Shopify has formed, is now coming out with a platform where they're going to have an agent, so to speak, go through and help you shop, that type of thing. So we're seeing all these developments take place, but that just hasn't really benefited PayPal. They've just lagged behind as far as changing over time. I mean, you have to go back to where we were many, many years ago. With the internet, as far as payment goes, people didn't trust the websites and they wanted to go on to and say, well, I'll use PayPal. That's pretty well all gone. And they're trying to find relevance, and they just haven't been able to innovate properly to actually grab some of that market share for the future.
Do you think then, because analysts are saying like this is going to be a longer road to recovery than maybe initially expected. Is this even a road to recovery, do you think, for PayPal, or is it a downward?
They're going to have to do something because they've been pushed. They're being pushed out, basically. You're seeing other companies like Visa, MasterCard come up with much better platforms. Like we're seeing all of this, and PayPal's the one that's really losing out, and so it's been underperforming. I mean, sure, maybe it bounces back here. Maybe analysts will come back and say, well, let's see what happens on a go-forward basis from here. Are they able to establish the relevance? But they're starting to really lose relevance in this crowded space and becoming more crowded. Their platform just hasn't been able to keep up.
Okay, we're going to take another quick break right now. When we come back, though, Brooke Thackeray, research analyst at Global X, is going to be taking your questions on First Call. That's right after this. Welcome back. It's time now for our First Call segment with Brooke Thackeray. We're going to start with an email from Mike, and that email reads, "Good morning, Brooke. Would you be buying CP now, given its typical seasonal strength is in the past? Thank you kindly." Okay, Canadian Pacific, what do you think about CP?
So I think CP is actually a good place to be right now, and I think the person that emailed in was talking about the seasonality as far as that goes, but CP can actually do quite well here on a seasonal basis as well. We're seeing the economy still holding up quite strong, particularly in the U.S. Canada, not so much. We've seen CP really bouncing along here a little bit. It has picked up a little bit here, but I think CP is still in a good place. I think the rails can still do well. The industrial component, as far as the shipping goes, with CP, I think is the manufacturing is slowing down in Ontario, but in the States, we're still seeing things like PMI picking up, et cetera. So I think CP is actually a good place to be.
Okay, we're going to move on to an email, this one coming in from Carl. It says, "May I have your opinion on Bell? The stock has been moving up slowly. Do you think it will break out?" So just full disclosure, of course, Bell Media is the parent company of BNN Bloomberg. What do you think about BCE right now?
Yeah, we've seen Bell actually do quite well recently. I think these dividend stocks are actually going to do quite well, and Bell would be part of that. BCE would be part of that. I think it's a more conservative stock at this point, but I think that's what investors are looking for in this market. We're seeing this shift away from the growth sectors. We're seeing more value investors. We're seeing more attraction back into the dividends as well. So I think Bell at BCE can actually do quite well.
Why do you think we're seeing that shift away from like stocks that are just kind of shooting upwards?
People are starting to question the valuations because the valuations have moved up so high, and they're saying, well, can we support it? Like we were talking about AI earlier. A lot of money has gone in there, but is it going to really pay off in the short term? Sure, longer term, but in the short term over the next little while. And we're seeing questions around that. We're seeing questions around private credit as well. Same thing. There's a lot of questioning going on with investors about valuations in the market. So we're seeing value stocks actually do well. And so BCE would be one of those stocks.
Okay. Okay, another email, this one coming in from Jim, and it says, "What are your thoughts on SHLD, the defense sector ETF?" Is that Shield?
That's Shield. It's actually a Global X ETF, for full disclosure. I work for the company.
Okay.
I think it's an excellent sector to be in right now. We're seeing a lot of money being spent in the defense sector. Yes, we may see some peace in Ukraine, which would be great. Maybe there won't be an attack on Iran, which would be great. But we're seeing the commitment to spending increase from right across the board. And so the sector, I think, is primed over the longer term to do extremely well. On a seasonal basis, the sector tends to do well in January and February. It tends to be just because of the purchase cycle that tends to take place for the sector. And it has done well, but I think we're going to see it actually extend past that this year because there's just so much emphasis. And investors are looking, once again, for something with more predictability for the future. And governments saying they're going to spend huge amounts of money in the future is attractive for investors. And
it seems like that spending, like as you say, that's going to happen regardless of what's happening geopolitically.
Geopolitically, if there's war, sure, it'll bump everything up a little bit, but the spending's going to take place whether there's war or not war.
Yeah.
And it's a long-term cycle. It's not like you can turn it on and turn it off. They can't say, oh, we're going to go to 5% of GDP and all of a sudden go, okay, we're going back to 1 or something.
Yeah.
That commitment is already there, and they're actually making all those adjustments.
Okay. Another email, this one coming in from Peter, and it reads, I'm looking at the uranium area. Does Denison offer an opportunity for investors? What do you think? I mean, we were talking about uranium earlier. Denison, do you have any thoughts on this specific mining company?
Sure. Well, first of all, I think Denison, all the uranium mining companies, I wouldn't say anything negative about that sector. Cameco would be an excellent choice as well. That's the granddaddy for the sector. Denison is a smaller company. I think Denison is in a good place. It can do extremely well from here. It's company specific. I don't see any problems with Denison. So yes, I think Denison can actually do well, along with all the other uranium mining companies.
You don't think there's any uranium mining companies that can't do well at the
moment? I mean,
as you say, it's kind of like gold. You see uranium steadily going up.
I do. So there may be some smaller companies, when you get into the micro caps. That's not Denison, though. Denison is a large company. It's a very mature company as well. I mean, it went up almost 8% yesterday. So I think Denison can do really well. It's the real junior companies that you have to worry about. Is it valuable or viable operations? And that's really where you want to buy an ETF in the sector. But companies like Cameco, Denison, are, I think, good companies.
And better companies, like you're more watching uranium mining companies compared to like nuclear stocks, for example.
So utilities would be at the other end of that. And so the problem with utilities is it's actually been winning and losing at the same time. So utilities have gone up because they're part of the data center value chain, because they're the ones that are going to have to provide the power, right? But at the same time, as the uranium is going up in price, they're going to be hurt because they require uranium as well. So it's a little bit different. I'm actually focused more on the actual mining companies rather than the utilities.
Okay, that's all the time we have today on The Street. Thank you to Brooke Thackeray, research analyst at GlobalX, for joining us today. Appreciate your time. And stay with us. Andrew Bell is next with The Open, with markets opening just 30 minutes from now.